Good afternoon, everyone, and thank you for joining us for another one of Avant-Garde's free educational trading webinars. We are thrilled to have Brandon Karpeles back with us. He is the CEO of Sovreign, and he is back covering a three-part series for us on understanding Bitcoin. We are back here for part two, talking about the technical traits of Bitcoin. So this is going to be a good, really helpful presentation getting into the nitty-gritty. Brandon, are you with us?
I am. Thank you.
Yeah, great to have you back. Thanks for joining us. And you can go ahead and share your screen and pull up your presentation whenever you are ready. While you're doing that, just a reminder to those of us live in the Zoom room, if you have questions during the presentation, please type them into the chat box or the Q&A, and I'll get those over to Brandon to address at the end of his presentation. I do see your screen, Brandon, but nothing on there just yet.
Sorry, let me try this again. I think it closed out for some reason.
That's all right. Also, a reminder to everyone, we are recording this afternoon session, so please keep an eye out in your email inboxes for an email from us. That's going to come from info@tradeagt.com, and it will have the link to the recorded replay. Make sure you check your spam or your junk folders so you get that email. Aha, see something now.
Got it now? Okay.
Yeah.
All right.
There we go. There we go.
Okay.
Ready for it.
Awesome. Okay, so thank you all for those that are returning. Appreciate you coming back. And if you do have questions, I will actually put the chat up in the corner of my other screen here. If you do have something that's just eating at you and you can't wait till the end, feel free to go ahead because this is the technical part. This is the, last time we spent most of the time talking about Bitcoin as money and why it's important as sound money and what other assets are and that sort of thing. And the kind of the overarching theme was trust me on that let's understand the value proposition. Let's understand the 21 million cap supply. Let's understand the infinite supply of fiat dollars. This is going to explain how the network actually enforces those rules. So I get asked all the time, who is Satoshi Nakamoto? What if he comes back and changes the code? Well, none of that matters. And since the last time we talked, a very prominent news person with the last name Carlson got up in front of a crowd of people and explained that he doesn't trust Bitcoin because it was made by the CIA and a bunch of other conjecture that whether true or not is actually irrelevant. And I think this is a big part of what a lot of people are missing is that it doesn't matter who made it. The CIA could have made it. It could have been some agency embedded in the United States government that we don't even know about. But it doesn't matter because the code is open source. The technology is open source, and anyone can run the code, can check the code, can verify the code, and see if there are bugs, see if there are backdoors. And 16 years later, there have been hundreds of thousands, probably hundreds of millions of people that have looked at the Bitcoin code. And it continues to be run by individuals all across the planet because there is consensus that you can't change the code, that the network does credibly enforce its rules. And it enforces those rules by individuals running the software all across the world, tens or hundreds of thousands of people running the software, constantly enforcing the network rules. So I just wanted to put that out there as we get into this. And if there are some super technical questions about a specific thing, maybe even just throw it in the notes, and we can try to get to that later because this is sort of the most difficult part to understand for people that are coming at this for their first time. So with that, I will dive into what we have here. So the technology. One is the blockchain. I'm sure you guys have all heard this word. We talked about it a little bit last time, and I gave the explanation that blockchain is just a fancy word for database. And A database at the end of the day is just a ledger of transactions. All it does is record when something moves from one location to something else in terms of money. When you're moving money from one place to another, it's just a recordation of that transaction. And right now, that's done by a bunch of banks across the country, the commercial banks, individuals. And what the banks do is they record all those transactions in their own ledger. And then ultimately, at the end of the day, they get submitted back to the Federal Reserve. And then the Federal Reserve amalgamates all of those transactions done at the commercial banks. And then every 30 to 45 days settles those transactions. So moves the actual money. So in the interim, while you may see some dollars in your Venmo account or an ACH come into your account from someone else, you may send a wire out. None of that money is actually settling. That's just a temporary ledger recordation that's being reflected back to you as the end user. And most people don't realize this. Some people do. Forgive me if I'm explaining things that people in the financial industry already know, but I was in banking for over a decade and I had no idea how any of this stuff worked. So I think it's helpful when we're explaining the benefits of final settlement of the blockchain and why it only matters for moving money around because the blockchain is Bitcoin's record of financial transactions. You don't need it for anything else. There is no reason to put a piece of a real estate title on there, or a freight shipment, or any of these things. These are all horrible uses of the Bitcoin blockchain. It's slow and inefficient because it's decentralized. So because it's decentralized, and the nodes across the world have to update themselves. And by node, I just mean someone running the software, all communicating with other nodes in the network, other people running the software. And that's what gives finality and credible record keeping to the transactions that take place. So in the example I described before, the Federal Reserve is the single node. Our entire US dollar system is a single node network. There is one node, it is the Federal Reserve. They are the final arbiter of all transactions, of all recordations, of all movement of credit, money, etc. And that system is fraught with peril, obviously. You have a very concentrated amount of control. I think the Fed meeting is tomorrow, and you're going to have 12 people deciding on the price of money. Well, they control the ledger, they control everything. They get to tell you how much your money costs. They get to tell you what interest rates are. They get to determine how much liquidity is going to be in the market, how much borrowing do they want to take place. And that's because it's a single node network. No one else has any say in the network. They cannot credibly enforce a monetary policy. There are no other nodes that if Jerome Powell comes out tomorrow and says, "Hey, we're going to loosen credit restrictions and add a bunch of liquidity to the market," there's no one else that can push back and say, "No, you're not," because it's a single node network. And that is the beauty of the Bitcoin network and the blockchain technology is the nodes are distributed across. And so you have a 100,000 person Mexican standoff of saying, go ahead, change the consensus. The 99,999 rest of us aren't going to recognize your change. So you can run your own software, but you're not gonna be a part of the Bitcoin network anymore. And that's the value of a distributed ledger as opposed to a single ledger. Along with the benefits of being incredibly effectively impossible to distort the ledger of what happened and change transactions. That's what we talk about when we talk about immutable. When a transaction happens on the Bitcoin network, it is immutable. It can no longer be changed. There is no one that can create some sort of change to the blockchain and make everyone else accept it. That's not possible. So it ensures transparency and prevents fraud. So because the network cannot be corrupted, because you cannot change transactions, Everyone gets to see what goes on. And this is just a little side note, but this is a highly discussed topic in the Bitcoin space of, transparency versus privacy. That while the transactions are anonymous in terms of you don't know who sent them, everyone can see the transaction. And if you bought some Bitcoin on an exchange where they took your information and have your driver's license, someone with access to that database, say you bought it at a company like River or at Strike, someone with access to those databases knows exactly how much money you have, where you sent it, and can track it through the blockchain. And that's actually how our law enforcement agencies have caught many of these frauds. Um, and when I say prevent fraud, I don't mean law in law enforcement terms of preventing fraud. Like someone conned you into giving you their Bitcoin, they have it, and they go get it back. That's not the fraud I'm talking about. What we're talking about is invalid transactions, transactions that don't fit the protocol. So someone tries to send 22 million coins. Well, that transaction is going to get rejected because it's a fraudulent transaction. It doesn't adhere to the rules of the network. There can only be 21 million coins, so we know it's a fraud. Or if someone tries to send a fake transaction from Bitcoin they don't have, or something like that, the network will reject the transaction. It will not get implemented into the blockchain. It will not get put into a block. It will not be mined. Um, it will not be able to be broadcast to the network. So, without getting too deep into it, effectively, at the end of the day, the Bitcoin blockchain is enforced by something called proof of work. This is a colloquialism, a term. It's not a technical definition or anything like that. And what we mean by that is you have to spend actual work. You have to spend real world energy to get the privilege of creating the next block. And so you have miners. These are people running what are called ASICs machines today. So it used to be you could do it on a laptop and then you needed a gaming computer. But these are people that they're called miners, but think of it more like people rolling a quadrillion-sided die over and over and over and over and over again. And they are spending energy to roll that die, to command the ASIC or the computer, the specific purpose, the single purpose computer to roll that die over and over again. And this is what's called hashing, and colloquially referred to as mining. But really, what it is hashing. You're entering a string of numbers into the SHA-256 cryptographic elliptical curve, and then you're getting a string of numbers out on the other end. And it can only go one way. It's like a lobster trap. You can only put numbers in and get an output. You cannot reverse engineer it. So there's absolutely no way for someone to take the output and know what your input was. You can only put the input in and get the output. And that output is the number that's generated, and that number will determine whether or not you are able to mine the next block. And that number has to be below another number. So think of it like a deck of cards, but the deck of cards has 100 cards in it. If you pull cards one, two, three, four, or five, you get to mine the next block. But if you pull cards 6 through 100, you do not get to mine the next block. And so you got to keep pulling a card until you get below it, or someone else pulls a card and they beat you to it. This is I use the deck of cards analogy because it's a little easier for people to visualize in much smaller numbers. Now multiply that analogy by a trillion, and that's effectively what's going on with these computers. So it's nothing complicated, it's nothing hard. It's just very large numbers being processed over and over again. And the network will get more or less difficult depending on how many people are doing that. So if there's more miners hashing, it will get harder. And so instead of numbers 1 through 5 winning, maybe it goes down to numbers 1 through 3 winning. And if there's not enough miners on the network, it'll get easier to hash. And so instead of cards 1 through 5 winning, maybe cards 1 through 9 start winning. And um, that adjustment takes place every 2016 blocks, which is roughly every 2 weeks. And so the network will become harder to mine or easier to mine depending on how many people are on the network. So, which is a brilliant innovation that came with Bitcoin. A lot of people had kind of solved everything except the difficulty adjustment. That kind of was the final piece. And I won't get into the history of the 50 years of technology that led up to the invention of Bitcoin, but that was kind of the last puzzle piece was the difficulty adjustment. That you couldn't just throw infinite computing power at the network and get all the coins. That it would get harder or easier depending on how many people were on the network. Um, and so as I mentioned, when you win that race as a miner, you then get to add the next block to the blockchain. So we're currently somewhere around block 912,000, something like that. So there have been 912,200 something blocks so far to date since 2008. Excuse me. And when the next miner wins the next block, they'll get to add one more. And that's why it's called a blockchain. It's just a chain of blocks added on top of each other that record all the transactions that have ever happened on the Bitcoin network. And that is provides security to the network in that it would require an extraordinary amount of computing power to change the network. It's effectively impossible at this point. There's too much energy being expended on the network to be able to uh, reorganize. It's called a reorganization to reorganize the blocks in a way that didn't originally happen. It's effectively impossible at this point. So, um, as I mentioned, the miners are they get to put the next block in, and what that means is they get to take all of the transactions that are sitting out there waiting to be put into the blockchain, and we call that the mempool. Think of it just like a queue. It's just a line to, like Disney World. Who gets on the ride next? Same thing. Who gets in the next block? Does my transaction get confirmed in the next block, or do I have to wait another 10 minutes or another 10 minutes? It depends how much I want to pay. So generally speaking, miners will take the highest paid transactions of people that want to get their transaction done as quickly as possible. They will get the fees for those transactions. In addition to that, they also get what's called a block subsidy. So every block a miner mines, today they get 3.125 Bitcoin. In 2000, April of 2028, roughly, it'll become half of that. And it's been halving every 4 years since 2008. So it started at 50 in 2008, went down to 25 in 2012, went down to 12 and a half in 2016, went down to 6.125, and now we're at 3.0625 or something like that today. That number will get cut in half and it'll be 1.5 something starting in 2028. And that goes on forever, all the way until the year 2140 when the last Bitcoin will be mined. Actually, it'll be a fraction of a Bitcoin, but the last fractional unit of Bitcoin, aka a Satoshi, will be mined. And so that is what incentivizes miners to continue to produce the blocks, is the monetary reward of both the fees and the block subsidy. So there have been many debates in the Bitcoin space about what happens when the block subsidies run out. No one's going to be incentivized to mine. I'm of the opinion that the fees will be plenty to continue the network on, and you're effectively just paying to move your transactions on the base layer. So that is the general technology behind it. Again, as we talked about in the first part, because of all this technology, people really mistake Bitcoin with a tech project. They even a lot of traders, and I know some people on this call are part of that committee, treat it like or community, excuse me, treat it like a high beta NASDAQ or, because it is this new technology. It's a 16-year-old technology. And yes, while there is technology behind Bitcoin that allows Bitcoin to function as a monetary network, really Bitcoin is a money. It's a money. It's its own monetary network. It's its own medium of exchange. It's its own store of value, and it's its own ledger all in one. Something that's never been seen before in history. And because of this innovation and the technology, people a lot of times conflate Bitcoin as a tech stock or something like that. But even the biggest tech stocks in the country, in the world, are only, 3 to 4 trillion dollar market caps, and the market cap for money is in the almost a quadrillion, which is the number that comes after 999 trillion. So we're talking about an addressable market that is orders of magnitude larger than just your next tech stock, and um, that is something people get conflated all the time, and I really try to help separate for people just so they understand the magnitude of what we're talking about here. This isn't the next Nvidia. This isn't the next Apple. This isn't the next Amazon. This is the next equity in your real estate, equity in your stocks, equity in well, no one has equity in their bonds. They're all underwater because you're being debased faster than the bonds can print the coupon. But anything that has a monetary premium, um, that number is around 900 trillion today. So that's the total addressable market for Bitcoin. It's the entire monetary value of everything in the world today, not just the value of a single company. So why Bitcoin matters? We talked a lot about the decentralization, the nature of the node network, and the ability for people to run their own software. And this is so important. We have been, I'm just going to say it, we've been slaves. We've been debt slaves to a system of total centralized control over our money. We have absolutely no say in anything. We can't even choose not to use the US dollar. We're forced to use it. We have to pay our taxes in it. We have to accept it if we're a business owner. We don't have a choice. There's legal tender laws. We have absolutely no ability to escape from state control of money. And now we have a system where people can, for the price of an old laptop and free software, can run their own node. They can be their own Federal Reserve in a new monetary network. And that can spread out over the world. And the ability for governments to stamp out users of this network is zero. China tried to do it. Kazakhstan tried to do it. The network, the users, people just move to where they're better suited. And at the end of the day, they're even with bans or illegal edicts or things like that. At the end of the day, there's absolutely nothing stopping someone from sending a transaction on this network as long as they have an internet connection. So it's really important. I'm sure a lot of you remember the Canadian truckers and what happened to them. Their bank accounts were closed, whether you agreed with the protests or not. You should probably be a little bit wary of the fact that a government just decided they could debank someone at a whim. And, you know, they did it to one group of people this time, they'll do it to a different group of people the next time if it's not in their best interest. So the ability to extricate yourself from a completely government controlled money is only possible because of the sort of whack-a-mole scenario of trying to shut this network down. It's just impossible. So that's why Bitcoin has been so resilient. That's why it's survived this long and will continue to survive because it's impossible to stamp it out. Um, I guess I touched on those points already, so I did a bad job of slide showing there. Apologies. The fixed supply, we talked a lot about this the first time, so I won't spend too much more time on this. But the fact that there is a known amount of Bitcoin that will exist, it's perfectly scarce. You can't create more of it if there's more demand. I'm sure everyone has seen the price of gold ripping these days. guess what? There's going to be more mining companies. They're going to go find more places to go mine gold. You get the price high enough, and your capital costs all of a sudden make sense to go start a mining company. You can't do that with Bitcoin. It doesn't matter. They can't make more. They can't make it faster. It's a set schedule. It's a fixed supply. And because of that, you know exactly what your money is going to be worth in the future. You know exactly what percentage of the monetary network you hold yourself or your company holds, or any other organization or entity holds. So it's known supply. Um, Sorry. And we talked a lot about the global accessibility already. Anyone can access this with a phone, a laptop, anything. There's people in Africa that are using flip phones and sending Bitcoin to each other via phone numbers. So it's accessible anywhere in the world. They don't even have landlines there. A lot of places don't have internet connections even. But they're they're sending over mobile phones in many places of the world. So I know it says with anyone with internet access, it's even without internet access too in some cases. And I gave the examples of some African nations using it that may not have access to the traditional banking system. And this is the last slide. This is kind of a lot of just sort of a summary of all the stuff that we've talked about in the first couple seminars here. Bitcoin is fixed in supply. It's limited. There will only be 21 million fiat money. People ask a lot of time, what do you think the price of Bitcoin is going to be? Well, priced in fiat, it's infinite because fiat has no end. They're going to just keep making more money, and that's why Bitcoin keeps going up forever, and it'll continue to go up forever unless somehow they decide to crash the entire economy, implement austerity, and fix the supply of fiat money. But I think if you aren't laughing right now, I'm sure there's some chuckles as to that ever happening. So uh, it's available to anyone, anywhere in the world. There are no borders. There are no legal tender laws. There's no you're going on a European vacation or a vacation to South America having to exchange your money and use whatever local currency is forced upon the people of that population. So it's usable anywhere. And inflation, this is just a result of its limited supply, that it resists inflation because you can't inflate the currency. And fiat money, they're just going to keep printing it forever. So, um, I think we have a couple minutes left here, so I know I raced through those last two slides, but it was kind of just a summary of things we have talked about in the last 2 weeks. So, if there's any other questions or anything at this point in time, happy to answer them. As always, you can reach out to me at B Karpeles at Sovreign. I can type that in the chat here um, for any questions you might have, or if you just want to talk more, if you want to set up a phone call with me or with us, I am happy to talk to anyone at any time. So please feel free to reach out. Love talking to people, especially professionals in this space, and happy to talk to anyone.
Thank you so much, Brandon. Yeah, I'm gonna just have you leave this up for a moment while we wrap up here. As Brandon noted, if you have questions, go ahead and type them in the chat, or he was kind enough to put his email in that chat, copy it down and reach out to him directly. One question that we've gotten before, Brandon, when you were talking about, kind of the mining strategy, I think on your first slide for this session, you brought the analogy up of kind of rolling the dice or pulling a card out of a deck. Can you address, and I don't know if you've gotten this question before, but has anyone ever brought up, is that just like going to a casino and rolling a die over and over again and hoping that it hits and it's your turn? How is that different, or is it different?
So, in reality, no, it is no different. That's exactly what it is. It's a giant roulette wheel with trillions of numbers on it. However, if you get enough hash rate, or what most people do now is they join a pool. So there's some very
Mm-hmm.
large players in the industry that control a lot of the hash rate, a lot of the mining compute power, and you can join them as a pool. So you can point your hash rate to a pool, and you can whatever percentage, so say you're 0.5% of the hash rate being pointed at one pool, you'll get a payout of 0.5% of the fees and the rewards that the owner operator of the pool gets. So a lot of people have done that. Some people do solo mine. Some people just run one miner in their house and they're like, maybe one day I'll hit it. For 99% of the people, they're going to go to their grave getting nothing. But at the end of the day, it's really for the larger players, for the people expending a lot of hash power. So these public mining companies like a Riot, um, uh, someone like that, that really what they're doing is they're doing an economic calculation saying, here's my energy cost, here's my capital cost, here's my projected share of the network based on the amount of hash rate I'm going to be able to point at it. And they just do a cost benefit analysis and they say, okay, here's how much Bitcoin I'm going to mine. Here's roughly how many fees I think I can get. And then what's my cost on the bottom? And I think today we sit at you really need to have around 3 cents per kilowatt hour energy cost or less to be profitable on a larger scale. So the larger scale operations are sort of taking the lottery element of things out of it by pointing so much hash to the network that they're able actually to guarantee themselves some portion of the fees and subsidies.
Gotcha. Okay, thank you. And we did get another question just right here at the end coming in from Donald. He's asking, would AI help create the code? I'm not completely sure if he's referencing the blockchain code or, the mining activity, but do you have any insight as to how AI comes into play here, if it does at all?
I mean, there's like the intersection of Bitcoin and AI is like endless. But at the end of the day, I mean, the code's
Maybe
already.
another webinar on that one.
Yeah, oh gosh, that's like 5 webinars. But uh at the end of the day, the code's written, it's done, whether AI was used or not back in 2008, I have no idea. But you could certainly have um AIs writing templates for miners, like a profitability analysis for miners, where you kind of just plug something in, like here's our energy cost, and they could run out a 10-year model of what you could expect. But the Bitcoin code itself is already written, and again, any changes to that, whether it's AI or human changes or anything, uh, now you're running a new version of Bitcoin. You're not running Bitcoin anymore, and you would actually create what's called a hard fork, and a new chain would be created, and you're certainly welcome to do that, but I say, good luck getting people onto your network. So any change of the code, and that gets back to um, the um, the security of the network, is that any change to the code would immediately be flagged by all the nodes on the network, and it would reject any transaction you tried to put through that new line of code. So I
Okay,
hope that
understood.
answered the
Yeah,
question,
that's
or
helpful.
um,
Yeah, no, I think you did. Thank you. Appreciate it. We are right at our end time, so I'm going to go ahead and take the screen back just to wrap up here. Thank you, everyone, for taking the time to join us live. Thank you, Brandon, for another great presentation. Just a reminder to everyone here, if you haven't already visited our site at tradeadt.com, go check us out and open your trading account today. We have free commissions membership pricing through the end of the year, so take advantage of that while you can. And don't forget to visit our site Again, you can find us at tradeagt.com. Hit the education page and make sure you sign up for our next upcoming webinars. They're all on this site. You also can sign up on the right-hand side, put your name and email, click submit, and you'll get email invitations to our webinars. Don't miss out on part 3, the final part of this initial Bitcoin education series we're doing with Brandon. It's going to be on November 4th at 12. Again, part 3, why businesses should care about Bitcoin. So definitely register, even if you're not sure you can join live. By signing up, you'll get a link to the recorded replay. Brandon, thanks again for everything, and we look forward to having you back for part 3.
Yeah, thank you so much. Looking forward to be back to part 3. And as I said, please, I know sometimes people are shy, but don't be shy. Please reach out to me if you have questions. My email I threw there in the chat. Please feel free to reach out.
Fantastic. Thanks so much. Thanks to everyone, and we'll see you at the next webinar.
Thank you.